let's explain what an ETF is so people.
Yeah. You've talked about ETFs a lot, and most people have gotten pretty good, but I feel like there's like a base understanding that wasn't fully set in most of your podcasts. So if we start from square one, they were invented by a guy named Nate Most. And you've actually talked about this recently in one of your podcasts. Somebody talked about like receipts. So you would give money to like a warehouse, and then you could use those receipts to say, I own X, Y, or Z. And they were called commodities warehouses, but he used that logic. So essentially, if you had, I don't know, 10 bars of silver or a bunch of bushels of grain, whatever, you would give it to the warehouse and they would give you a piece of paper that says, we confirm you have this, this is the receipt. And if you ever want, you can go to the warehouse and take that commodity out. That's the basis for how an ETF is supposed to work. That piece of paper is worth whatever that commodity is. But he did it to more than just commodities. The first one was the S&P 500 ETF. Well, the first ETF was actually in Canada, but it was based off of what was being designed in the US. Anyway, what it really does is it takes those pieces of paper, and if you think of those pieces of paper of a commodity warehouse that I was just talking about, those are essentially the shares of the ETF. And there's custodians that hold the underlying assets. So if it's equity, say that you would make an index of 10 stocks. The way an ETF works is there's a mechanism where you can create and redeem shares of the ETF because those 10 stocks are equivalent to some number of shares. So for every 10 stocks I hand, I can get, I don't know, we'll say 10 shares of an ETF. So at all times, those 10 stocks, I can trade them in for 10 shares of the ETF, or I can trade in 10 shares of the ETF for 10 shares of the stock. So the way it actually works is it's like 100,000 shares of the ETF and 500 stocks in some proportion for the S&P 500 or whatever the ETF is. But the whole thing is really, I can do an in-kind transaction, which the big benefit is that that's a taxless situation because you're just doing in-kind. You're giving shares for shares, and there's no taxable event that occurs. So that's one of the big reasons why ETFs are so efficient. So if we ever spot Bitcoin ETF, the way it would work is you would hand in Bitcoin and you would get some number of shares in return, and that is it's not a taxable event right now. So that's a huge advantage versus what the way usual funds work is I give you money, that fund goes to buy something, and then I try to return, they have to sell something. Those are both taxable events that have to occur. So the way an ETF works, the reason why it works so well is because of that creation redemption process in that in-kind transaction. The first type of fund was what's called like a closed-end fund, and that's more similar to what GBTC is right now. So a closed-end fund is like, I'm going to start a company, and instead of doing something like Apple and making electronics, I'm going to invest in other companies. So you have an IPO, and then you invest in bonds or stocks or what have you. The problem with that is there's no mechanism to say the underlying has to be worth X or Y because we know what the underlying is worth. So the shares of this company have to be worth whatever that is because that's all that's involved, right? But there's no mechanism to arbitrage that out. It's the same way a company works. A company, its price will fluctuate wildly, but its actual value is indeterminable for the most part. Like you can kind of figure out what it is. But like for a closed-end fund, like say it holds those 10 stocks, right? And we know what those 10 stocks are trading at, but the closed-end fund doesn't have to be trading at that price, right? With an ETF, it's a technology, it's a wrapper. It's advanced technology to get efficient exposure to anything. No matter what happens with an ETF, when it goes into a market, it democratizes everything. Prices come down to hold it, prices come down to trade it. It's a very good technology in the asset management space. But the reason it works is because of that mechanism I spoke about. Those shares are always going to be equivalent to the underlying because you can always exchange them. If all of a sudden those shares are worth $10 more than the underlying stocks, I'm going to give you the underlying stocks and take the shares back, or vice versa, because there's an arbitrage mechanism there, right? So like at any point, if it gets too out of whack, somebody's going to come in and basically say, all right, fine, if this is worth $10 more, I'm going to create more shares, give you the stocks, and I'll take the ETF, or vice versa if it's worth $10 less, which is what GBTC is missing, right? You can't hand in the shares and get Bitcoin in return, because if you could, you would be sitting really nice right now. That's the whole problem. So ETFs allow for that. It's called NAV, net asset value, is what the underlying value of the holdings are worth. And then the price is the share price. With an ETF, the NAV and the price are almost always going to be very close in line. There are instances where that doesn't happen, and usually it's problems in the underlying market, which we don't need to get into. But for the most part, that creation redemption mechanism, like my boss likes to call it the flux capacitor. Like that's how everything actually works in the ETF world. It's a non-taxable event, and it makes sure that NAV and price are always in line. Now, normally it's not people like, oh, this is deviated a little bit, I'm going to go hand in the shares and do this. Mostly it's just part of day-to-day trading. There's people trading, there's authorized participants. There's people out there just making markets in the ETF, and it keeps things in line. But there are times where if things get really out of whack, somebody will come in and be like, there's an opportunity here to make, I don't know, 3 basis points. And if I can do that on $1 million, that's a decent amount of money in one trade.
Okay, so they're basically super efficient markets.
Yeah, so like the way to think about it is like a stock, right? You have a fixed supply of shares for the most part. Obviously, companies issue and buy back shares, whatever. But like demand is what drives the price, right? As demand goes up, the price is going to go up because the supply is fixed, right? With an ETF, when demand goes up or goes down, you can change the supply. So you are moving the supply, not you, but the market itself and authorized participants, market makers, Wall Street, if you will, are making sure that supply is always in line with demand. So if you just think about it as 2 bars, basically it's just the market constantly moving that supply bar up and down to keep in line so that NAV and price are the same, which again is what's missing from GBTC.
And you can also create some quite exotic products with them. Baskets of, you could, like I say, I want to invest, say, in Bitcoin miners, public Bitcoin miners. To save me having to go out to every single miner and buy shares, you could just create a basket of all public Bitcoin miners. You can hedge yourself. If you think, right, I think certainly Bitcoin miners are going to be super successful over the next 5 years. I don't want to have to pick a winner. I don't want to have to spend time studying each of them, but I know the market's definitely going to grow. Someone can create an ETF for that.
Yeah, there's a bunch of ETFs out there that do that. And honestly, it's not even that they have to be super successful. There's plenty of ETFs out there on things that people expect to fail. And basically they'll use it. So ETFs were initially invented to be trading vehicles. So like people can short them, you can buy options on them, you can do anything you want on the underlying market, which we can get into.
Is there anything you can't put into an ETF?
There's some nuances. Basically, there needs to be an underlying liquid market. So the way an ETF works is like if you think about it when you're trying to see how much does it trade. So if you're an institution, you care how much it trades. For an ETF, it's not as critical as much how much it trades, because if the underlying trades enough, like I said, you can always exchange those shares. So a market maker, somebody who's making markets in these ETFs, if the underlying market, if it's an ETF, it only trades 100 shares a day, but its underlying stocks that it holds are the S&P 500. A market maker can arb that all day. They can give you 1 million shares in a second without any issue, because the underlying market is what makes the ETF liquid. So there are instances where the ETF becomes more liquid than the underlying. We call those pseudo future ETFs. They're like just super high-powered trading vehicles. Most of them have been around since like 2000 or earlier. But for the most part, the real liquidity, we call it the primary liquidity, is like the secondary layer, what is held in that basket. And you can hold bonds, commodities, ETFs, futures, derivatives, and they've made rules over the past few years to make it easier to do these things.
And can you have ETFs which back up like a basket of multiple ETFs?
Yes, you can. Yeah. So there are ETFs. So like iShares, for example, has a bunch of ETFs where they'll hold their underlying ETF and then do a currency hedge on it. So like say you want, I don't know, UK exposure, but you want to hedge the British pound exposure. So they'll hold their UK ETF and then they'll offer a hedged UK version where it just literally holds the ETF. And then there's also a bunch of issuers where they're like, all right, we're going to actively manage our ETFs and rotate through these different sectors, what have you. You can do a lot of it's a technology. It's a wrapper. That's the way to think about it.
Just quickly going back 1 second. In the Michael Sonashine interview, we asked that if he allowed with that redemptions, would it bring the discount back to par? And he said he didn't think it would necessarily. Is that just wrong?
The problem is, like, my big thing is, like, if we just allow redemptions and we don't allow subscriptions, GBTC's broken in the opposite direction, which is basically what happened. Like, should we just get into the history of GBTC?
Well, let me ask one more question before we get into that then.
Okay.
Do you remember the Cullen Roche interview?
Yeah, but
Cullen's great.
Cullen is great. So he talked about his investment thesis is, he was like, I'm like a third equities, a third gold.
He has an ETF.
I was going to say,
does this. There's an ETF that does this.
I was going to say, you kind of want a hard assets ETF, which is a bit gold, a bit Bitcoin,
I assume they exist today, apart from with Bitcoin.
They do.
Bitcoin. You want one with Bitcoin in as well. So like, you know, that's it thing where I want a little bit of gold just in case, you know, and that I feel like if there was a hard assets ETF, I would be interested in that.
Yeah. So right now, the only way to do that would be just with Bitcoin futures, which isn't really what most people really want.
And sorry, before we get into the history of the GBTC thing, can anyone invest in ETFs, or does it have to
Anyone. If you, it's just like buying a stock. So if it's an ETF, for the most part, you can just go onto your whatever brokerage trading platform and you can just type in the ticker and buy it.